When international businesses consider entering the Danish market, one of the most critical topics to understand is the tax consequences of having a permanent establishment in Denmark. In this video, we will walk through what constitutes a permanent establishment in a Danish context, how it is taxed, and the key implications for your broader group structure and compliance obligations. Our objective is to provide you with a clear, structured overview that can inform board-level decisions and help you engage effectively with your tax and legal advisors. Let us begin with the concept itself. A permanent establishment, often abbreviated as PE, is generally understood as a fixed place of business through which the business of an enterprise is wholly or partly carried on. In Denmark, this concept is anchored in domestic tax law and interpreted in line with the OECD Model Tax Convention and relevant double tax treaties. Common examples include an office, a branch, a factory, a workshop, or a construction site that exceeds a certain duration threshold. Beyond physical locations, a PE can also arise through a dependent agent, someone in Denmark who habitually concludes contracts on behalf of a foreign enterprise or plays the principal role leading to their conclusion. Once your activities cross the threshold into what Danish authorities regard as a permanent establishment, the tax landscape changes significantly. The core consequence is that Denmark acquires the right to tax the profits that are attributable to the permanent establishment. These profits are subject to Danish corporate income tax, which is levied at a flat rate, currently in the low 20s in percentage terms, in line with many other EU jurisdictions, but important to verify at the time of your investment decision, as rates can change through legislative updates. In practice, determining the taxable profit of a Danish permanent establishment follows the arm's length principle. The PE is treated for tax purposes as if it were a distinct and separate enterprise dealing independently with the rest of the group. This means that you need to identify the functions performed, assets used, and risks assumed in Denmark, and then attribute an appropriate level of profit to that profile. Intra-group transactions, such as the provision of management services from headquarters, the licensing of intellectual property, or intercompany financing, must be priced on an arm's-length basis and supported by contemporaneous transfer pricing documentation that complies with Danish requirements. From a compliance perspective, once a PE exists in Denmark, you are required to register with the Danish Business Authority and the Danish Tax Agency for corporate tax purposes. This typically entails obtaining a Danish tax registration number, maintaining proper bookkeeping under Danish rules, and filing annual tax returns. Depending on the nature and scale of activity, you may also need to register for value-added tax, with 25% being the standard VAT rate, and account for employer obligations such as withholding taxes on wages and social security-related contributions if you have personnel on the ground. It is essential to understand that Danish tax authorities take a substance over form approach when assessing whether a PE exists. Even if contracts are formally signed abroad, or you use flexible arrangements such as home offices or co-working spaces, the pattern of activity in Denmark can still give rise to a PE. For example, having a senior sales executive continuously operating from Denmark, meeting customers, and effectively concluding deals could be sufficient, even in the absence of a formal legal entity. Similarly, a long-running construction, installation, or project management site in Denmark may constitute a PE once it passes a particular time threshold, often outlined in Denmark's tax treaties with the relevant home country. On the international side, the existence of a Danish PE interacts with the tax rules in your head office jurisdiction through double tax treaties. In many cases, your home country will grant a credit or exemption to relieve double taxation, ensuring that the same profits are not taxed twice. However, this is not automatic, and the mechanics differ materially between jurisdictions. Proper alignment between Danish filings and head office tax returns is therefore crucial. Inconsistent reporting of profits attributable to the PE across jurisdictions can attract scrutiny and, in the worst cases, double taxation that is costly and time-consuming to resolve. Further, having a PE in Denmark may also influence your group's transfer pricing model. For instance, Moving from a limited risk distributor model to one where you have substantive decision-making in Denmark will often require a reallocation of profits toward Denmark, with knock-on effects for other countries in your structure. Another dimension to consider is indirect tax and payroll implications. While a PE for corporate tax purposes does not automatically equate to a fixed establishment for VAT, the two are frequently connected in practice. A Danish presence with sufficient human and technical resources to supply services locally may constitute a VAT fixed establishment, changing which party is responsible for charging and remitting VAT. If you employ staff in Denmark, you must also navigate Danish payroll tax rules, labor market contributions, and potential employer reporting obligations, all of which can be triggered by a relatively small footprint. From a risk management perspective, an unrecognized or late recognized PE is a particular concern. If the Danish tax authorities conclude that a permanent establishment existed in earlier years, they may reassess your taxable income, impose back taxes, and add interest and penalties. This kind of retrospective exposure can be material, especially if your Danish operations have been generating significant revenues without corresponding tax filings. To mitigate this risk, many organizations conduct PE risk assessments when they expand sales teams, deploy project staff, or shift operational decision-making to Denmark. In some circumstances, it may be advisable to obtain advance guidance or engage in dialogue with the Danish tax agency to clarify the tax treatment of planned activities. Ultimately, there is no one-size-fits-all answer to whether you should operate through a Danish legal entity, a branch, or a more limited arrangement that avoids a PE. The right approach depends on your commercial strategy, the scale of operations, your tolerance for tax and regulatory risk, and your broader international tax profile. What is consistent across all cases, however, is that understanding the tax consequences of a Danish permanent establishment is fundamental. It shapes your effective tax rate, your reporting burden, and your exposure to audits and disputes. As you evaluate or expand your presence in Denmark, it is prudent to engage early with tax, legal, and finance specialists who have direct experience with Danish practice. Ensure that your internal stakeholders are aligned on the operational footprint and maintain robust documentation to support your position. By approaching the question of permanent establishment in Denmark proactively and systematically, you can reduce uncertainty, avoid unintended tax leakage, and support a sustainable, compliant presence in one of Europe's most attractive and stable markets.